The 294th meeting of the Central Bank's Monetary Policy Committee was held between March 25th and 26th. At the end of the meeting, the committee announced in a communique what its decisions were. It raised the MPR by 200 basis points, adjusted the asymmetric corridor, and increased the CRR of merchant banks from 10 to 14%, while retaining the liquidity ratio at 30%. While providing more insight into its current activities, it patted the Apex Bank on the back for stability in the foreign exchange market and also noted its effort in offsetting verified foreign currency obligations. Additionally, it urged the federal government to continue its interventions in the agricultural sector, as this would go a long way in addressing inflationary pressures in the country. Well, for more on this, I am joined by Gbemisola Longe, Consultant, Africa Practice. Thank you, Gbemisola, for joining me today.
Thanks for having me. Good morning.
Good morning to you too. Well, tell me, did you expect a hold or a hike? I mean, what has been your reaction to this news so far?
Yeah, I expected the Central Bank or the Monetary Policy Committee to increase rates because of the position of the MPC from, its first meeting. So if you notice from the first meeting, the committee was really big on establishing or reining in inflation, essentially. So inflation at the moment is at its highest in over 2 decades. So there's a need to, make big, bold moves to rein in inflation. And the MPC hasn't shied away from expressing that is what their goal is, and we're seeing more of that. So yeah, I was expecting, after the first of its kind rate hike from the first meeting last month, I was expecting yet another hike, but certainly slower than the previous, and that was what we saw.
Okay, so if I get it correctly, were you expecting as much as 200 basis points or 125 basis points or 100?
I wouldn't say exactly what numbers I expected, but yes, I was expecting it to be slower than before, but it hiked nonetheless.
Absolutely. Well, there are many analysts and, of course, businesses, especially SMEs, who will tell you that rate hikes have not effectively dealt with inflation in Nigeria. And then for them, they would say that the last rate hike probably resulted in more inflation, when you look at the numbers. So on the other hand, we have financial market analysts who have said the CBN must control money in circulation. So how do we balance these extremes?
Okay, so first thing is, whenever a decision is made, there's typically a policy lag. So the period between when the decision is made and when the policy starts to take effect in real issues or real factors like inflation. So according to a study carried out by some researchers and I believe a senior economist from the CBN, it takes about 20 months. The transmission lag for the monetary policy takes about 20 months for it to start to influence inflation in Nigeria. So that's one thing that we need to note. Another thing is, in Nigeria's inflation, according to a study by the IMF last year, Nigeria's inflation is mostly affected by supply chain issues. So 40% of Nigeria's inflation is influenced by supply chain issues. And then, I think about 18 or 20% is actually influenced by monetary policy issues or money supply. So first thing that we need to note is a lot is involved in, reining in inflation in Nigeria. And another thing is that it doesn't happen immediately. Now, if the central bank or the Monetary Policy Committee did not increase rates, what we would have seen was that it would most likely have increased, the inflation would most likely have gotten worse. And that is based on a counterfactual study that the CBN actually conducted last year. So around August or September last year, the last MPC meeting before this year's MPC meeting, what the CBN or what the MPC noted was that based on a study carried out by the CBN, if monetary policy rates were not increased, we would have seen inflation rise to 30% as early as last year from when it was 22%. So first thing to note is the monetary policy rate actually influences inflation. Okay. However, it takes a while. There's typically a lag of about 20 months before we start to see it start to influence.
Let me come in here. While we have this 20-month lag, we note that it has some impact on the real sector. So how do we close this gap?
So it does have an impact, but then, like I said, inflation is a contributor. fiscal and monetary policy factors contribute to inflation. So one thing to note is that the federal government also has a role to play in reining in inflation. The Monetary Policy Committee and the central bank, through its foreign exchange policies or reforms in the last 3 months, has been trying to basically influence or restore investor confidence in the economy. And we're starting to see that happen. But beyond that, the federal government must also sort of basically induce growth in the economy, while the central bank or the Monetary Policy Committee basically reduces how much inflation is happening while growth is being induced in the economy.
Well, I guess your response, of course, tallies with what the MPC said. They talked about, how that food inflation contributes a lot to Nigeria's inflation, and they are saying that they would like the federal government to do more to address food insecurity and all of that. So, yeah, I guess we're on the same plane. Now, let's look at this. Let's take a look at, other decisions of the MPC. They adjusted the asymmetric window to plus 100 and minus 300 around the MPR, as against plus 100 minus 700 during the previous MPC. What does this portend?
So typically, the asymmetric corridor is essentially aimed at controlling how much liquidity is available for banks. So the MPR determines how much the banks can lend or save with borrow from the central bank or save with the central bank. And so basically reducing that window means that the central bank is essentially, or the Monetary Policy Committee is trying to reduce how much liquidity or how much leeway is available for banks to basically borrow. So reining that in, it's been plus 100 minus 300 for a while now. So reining that in is essentially the CBN's way of still controlling inflation, reducing how much liquidity banks have, and as a result, how much they can lend out to other members of the economy.
I like what you just said about, reducing the liquidity in the bank. And we're looking again at the CRR for commercial banks. We've seen these banks borrow up to 24 trillion naira in the first 3 months of 2024. If you ask me or some analysts, they will tell you this is a telltale, sign of illiquidity. Do you think it's still sustainable to leave the CRR at 45 and still keep on, tightening and ensuring that we reduce liquidity in the commercial banks?
So one thing we need to notice, these contractionary monetary policies, so the rate hikes, they are not indefinite, right? So the central bank does not intend to leave these rates, or the MPC doesn't intend to leave these rates indefinitely. And we'll see this from what other global markets or central banks across other global markets are doing. In the last year or 2 years, there has been there's been an active fight against inflation globally. And right now, we're starting to see central banks across the world basically ease off a bit. Some have not started to reduce rates yet, but basically the rate at which they are increasing rates have started to reduce. And I believe that this is the same thing for Nigeria. We don't expect that the CRR will remain at 45% forever, but while inflation is still at a two-decade high, it's important for the central bank to make big, bold moves, and that's what's going on now. Now, is it sustainable? In the medium term, the central bank has to basically pull the brakes on how much money supply is available across the economy and how much, how much leeway banks have to conduct their business. And that's what's currently happening. I think that at the moment, in the short term, in the medium term, such bold moves have to be made, not only to rein in inflation, but also to restore investor confidence in the economy, to basically return or reverse the capital flight that we've seen happen in the last 4 years. So that's what the government, or that's what the Monetary Policy Committee is doing, the central bank is doing. And I think in the short to medium term, it still has to be done, it's still sustainable. And then as things start to improve, as inflation starts to reduce, we should see the central bank basically ease off on this a bit.
All right, we look forward to that. Let's talk about this. Now, the committee, when you look at the communique that they issued at the end of the meeting, that's the one they posted on their website, they actually sort of patted the bank, on the back for the stability we have seen so far in the foreign exchange market. There is no denying the pass-through effect, forex volatility has on inflation. However, there are some people who have said what has happened so far is not structural and might soon collapse before our very eyes if not supported with liquidity. Do you share the same sentiment?
But by what's happening? What exactly are you talking about? The federal, the foreign exchange or the NPC?
Exactly,
What
we're
part
talking
of it
about the
is not
foreign
structural?
exchange now. The foreign exchange now, where the MPC actually patted the bank on the back for the sort of stability we've seen so far in the foreign exchange market. And of course, we know that the foreign exchange market has a pass-through effect on inflation at the end of the day. So, and then there are some persons who are saying, yes, we've seen liquidity, not liquidity now, we've seen stability, and then we've also seen the CBN, selling forex to BDC, selling them to sell at a particular amount and all of that. They've said all of this really isn't structural. All of this really will not last. And they are, they're just probably scared or afraid that all of those things might just turn around, at the end of the day. What do you think? Do you share the same sentiment?
No, I don't. So what I believe is, so what the central bank has been trying to do in the foreign exchange markets is restore order. And the CBN governor has reiterated this on several occasions. So the goal is to ensure that investors have there's some sort of transparency in the market. If an investor wants to bring in their market and bring in their investments into Nigeria, they can see a clear path to which they can, repatriate their returns and even take out their money if need be. And that's why we have seen liquidity basically reduce in the market in the last 2 years. Investors have been very worried about, from 2020, what the CBN announced was that investors would need to wait to basically repatriate their funds in an orderly fashion. Now, this orderly fashion wasn't very clear to investors. We had businesses basically halt operations from Nigeria, and even we saw a lot of businesses, pull out of Nigeria as a result of, lack of foreign exchange and inability to get foreign exchange. Now, what's happening at the moment is that investors are investing with themselves. Investors are trading foreign exchange with themselves, and they're doing this at the market price. So if you need foreign exchange at any point in time, you can enter the market, the INA window, and you can get your funds at the rate that is prevalent in the markets at the time. Now, this alone reduces the pressure on banks and the central bank to basically plug in liquidity when they need to, because it's a willing buyer, willing seller method. If I want to buy foreign exchange, I should be able to basically buy it at the rate that a willing seller is willing to sell it to me. That's essentially what is going on in the markets. And this in itself is restoring investment or restoring liquidity in the markets. So, but what would have reduced inflow of investments or foreign inflows into the economy would have been if this wasn't supported by increased rates. So what is currently happening now is, beyond restoring order and assuring investors of their ability to take out money bring in money and take out money from the Nigerian economy as at when due, the MPC is then supporting it with high interest rates, such that basically the real interest rate is the negative real interest rate is reduced over time. So that in itself, basically injects liquidity into the markets. And we've already seen this. Last month, the CBN, or this month, the CBN announced that, their foreign exchange reserves were over, I think, $33 billion.
That it got up to 34.
Showing that, investors, exactly, 34 billion. So that's showing that investor confidence is being restored, and investors are basically more eager to bring in their money into Nigeria.
Well, thank you,
so I'm not worried at all.
Okay, thank you for bringing in that, sort of perspective. But now, beyond what the MPC is doing, which of course, to a very large extent, has to do with putting checks in place, order, and ensuring sanity, in the market. What more do you think the fiscal authority should also be doing? Because we're talking about production. That's where the fiscal committee comes in, or the fiscal authority, beg your pardon. Do you think the fiscal authority is doing enough? We've heard a lot about agriculture and even oil and gas, but is it really adding up?
So yes, indeed, like you said, fiscal policy is such a big part of reining in inflation in Nigeria, because most of Nigeria's inflation, 40%, like I said before, is driven by supply chain issues. So things like infrastructural challenges with power, transportation, and insecurity across the country. So fixing that or not fixing that will prevent Nigeria from producing as it should, will prevent Nigeria from being efficient in its production. Now, the fiscal authorities have tried to rein in inflation by first improving consumer consumption in the economy. So ensuring that businesses can still stay alive because they have consumers to sell to. But beyond that, we've also seen them basically induce, growth in the agri sector, which is still Nigeria's largest contributor to GDP. So inducing or injecting growth in this sector. But a lot still has to be done, especially in the power in the power sector. There still needs to be. Power is still a big challenge that businesses still have to grapple with in Nigeria, especially considering now that, the subsidy was removed last year. So alternative sources of power have become more expensive to sustain. So beyond, providing funds for agricultural for players and all that, the government still needs to do a lot in terms of inducing growth in the power sector, improving the transportation sector, actually unlocking. We have a train that we have train systems that were developed by the previous administration, but actually using this to unlock trade across the country is very essential. And then there's also the bit about insecurity. Businesses still have to grapple with the possibility of their staff being kidnapped or their goods being, not being able to get to its final destination as it should because of insecurity issues and insecurity problems. So until insecurity is also dealt with significantly in such a way that businesses can actually attest to the fact that this is happening, there will still be that lack of productivity or inefficiency in Nigeria. So, we commend the government for what it's doing in terms of unlocking growth and all that, but there's still a lot of work to be done.
I'll take that. There's still a lot of work to be done. Now, let's take a cue from, a country that's Kenya. The shilling went from being one of the worst performing currencies in the world to being the best, in less than 3 months. Also, inflation risks, have diminished due to the deceleration of the primary drivers, namely food and fuel prices. How did they achieve this? And are there any lessons here for Nigeria?
Okay, so I guess first place to start would be how Kenya got to where it did. So Kenya's economic challenges were driven by several things. So first was the climate change, weather changes that affected the agri sector significantly. And then we also had, they also grappled with issues around, the possibility of them defaulting on their Eurobond that's due this year. Now, the Kenyan economy was able to basically navigate this by supporting. First thing was that the weather became better, so weather issues reduced, and they're starting to see, rains return as usual. But beyond that, right, they got a lot of support from the IMF. So Kenya got funds from the IMF and was able to basically allay the fears of investors of its inability to meet its Eurobond payments, or it's the possibility of defaulting on Eurobond payments. So the fact that that is gone out of the way has ushered in investors again. So one lesson to learn is, if you notice that investors are a bit scared about your inability to meet your debt and everything, first thing is to allay those fears. And I feel like Nigeria has taken a cue from that by restoring order in its foreign exchange markets, because that was a big concern for investors. So like Kenya, based on getting support from the IMF, Kenya was able to basically roll out some new local debts that basically got investors interested again. So there was an infrastructure local debt, I believe, that Kenya rolled out in February, and that was oversubscribed. And it's a local currency bond, so that meant increased supply or increased demand for the Kenyan shilling, and that basically supported the exchange rates.
Thank you.
So I guess basically restoring order, getting investors more comfortable, and those are lessons to learn, essentially.
Thank you so much. And of course, the takeaway from here is that the CBN, or the MPC, as the case may be, has done a whole lot to restore order, but then we need to see more. That's on the part of productivity, and that, of course, goes to the fiscal authority. Thank you so much, Gbemisola Alonge, for sharing your thoughts with us today on Business Edge.
Thanks for having me.
The steering committee for Zambia's bondholders and the Zambian government have announced that they have reached an agreement to restructure Zambia's debt, which public sector creditors have accepted. Reacting to the announcement, the head of policy at Debt Justice, Tim Jones, said the deal is better than the first bondholder proposal that was rejected by creditor governments in October. But bondholders will still get paid back over 10% more than public creditors. From London, UK, Tim Jones, head of policy debt, joins me. Thank you so much, Tim Jones, for joining me today.
Hi, great to be with you.
Absolutely. Well, let's talk about this now. The steering committee for Zambia's bondholders and even the Zambian government have talked about reaching an agreement to restructure Zambia's debt, and then, which public sector creditors have also accepted. Is it Uhuru already?
It's better than the deal that was on the table in October. It does give significant debt relief to Zambia. We don't think it's as good as it could be or should be. And a big potential problem with the deal is that debt payments will increase by a very large amount if the IMF and World Bank make some small adjustments in their view of the Zambian economy. So there are some potential problems down the road. Also, this other creditors that they still need to strike deals with, as well as the bondholders. But it does give a potential end to these negotiations, which have been going on for so long.
All right, you've talked about a particular aspect where the IMF might need to, say that maybe Zambia's economy is getting better, and as a result, they would probably have to pay more. I would have thought that was a good one, because we also need to consider, the bondholders, not just the government. What do you have to say about that?
Well, the changes could be very minor, and some are not even related to the Zambian economy. So if the global economy is growing more, that's one of the changes that could lead to Zambia having to pay a lot more. And it's a cliff edge, so there could be some very tiny changes that lead to a huge increase in debt payments. But also, there is no corresponding fall in debt payments if the Zambian economy does worse than expected. So it's not reciprocal. And so the bondholders get paid either back a decent amount under the current deal, or they get paid back a lot more if these small changes happen. So it does cast a shadow over what could happen. That judgment will be made later in the 2020s, but it could end up leading to Zambia having to pay a lot more in the late 2020s and early 2030s.
All right, so what more do we need to know about this agreement, and how does it differ from the previous agreement? I know we've highlighted one or two things which of course stand out, but beyond these things we've pointed out, what are the other things that sort of differentiates this particular agreement from the previous one?
Mainly, it's just the bondholders are getting back a bit less. Before, we calculated that they were effectively getting repaid 73 cents on every dollar that had been lent. And under the new deal, we calculate they're getting repaid 62 cents. So there's a fall from 73 to 62, so that's savings for Zambia. And that's under the baseline deal if there aren't these big increases in payments following an IMF judgment. But that 62 cents is still more than the government creditors like China and the UK are getting. They're getting 55 cents. And so this means that bondholders are effectively still riding on the back of debt relief given by governments. And we don't think that's fair. These bondholders lent at the highest interest rates. They should have to be giving at least as much debt relief as governments have given.
All right, let's look at a requirement about enhanced repayment terms and higher coupons on Bond B if Zambia's debt carrying capacity, as assessed by the IMF and the World Bank, probably moves to medium from weak and all of that. So let's look at it. What are the factors that could affect, Zambia's economic stance?
Yeah, so there are things like the rate of growth of the global economy, not just the Zambian economy, and the level of reserves that Zambia has, remittances it's receiving from around the world, as well as exports, and then a whole host of judgments the World Bank makes about economic policies. And some of these can be quite contentious. things like privatization and trade liberalization.
If I get you correctly, are you saying that this judgment could be subjective and not necessarily objective? That's talking about, maybe Zambia's debt carrying capacity has improved, or any of the judgments that could come from IMF or the World Bank. Are you trying to say that it could actually be subjective and not objective?
Yes, there are so many different factors that go into the calculation that the IMF and World Bank can choose ways to skew the calculation in ways that they want. Now, we would hope that ultimately that means that they do stick with the better deal for Zambia, but we don't know that will happen. And it's a very weird clause to have included. If you want to make payments linked to whether Zambia does better or worse, you should just use something simple like how much has the government revenue increased in dollars. And you could do that and then say if the government revenue increases by more than expected, bondholders get a bit more. They should only get a bit. Most of that improvement should still be for the Zambian people. But then also you can say if Zambian government revenue is a bit less, then bondholders get less back. But that's not the kind of deal that's been done. What's been done is a very weird deal where just some minor changes could lead to an increase in payments of approaching 50%. And that is really such a huge increase in debt payments for Zambia based on some very small changes that ultimately lies behind a very subjective formula that the IMF and World Bank have.
All right, we know this particular process, that's having this debt restructuring and all of that, it's been beset by long delays. So help us put a picture of the impacts of the delays on maybe investment, economic growth, and the financial market so far, and how long it might take to reverse these trends in Zambia.
Well, there is an uncertainty created, and that might have impacted on investment. But there is also a flip side, that Zambia has not been paying the bondholders and governments for the last over 3 years. And that has meant they've been able to use those savings to invest in the Zambian economy. So actually, Zambia's spending in areas like healthcare and education has increased over the last 3 years. And the Zambian economy certainly has done a lot better than if they carried on paying the debt. The debt crisis did not begin in 2020 when Zambia defaulted. It began several years earlier when the Zambian government was cutting spending in order to try and pay the debt. So while this process has taken far too long, it also has been much better that Zambia has defaulted and used some of those savings to invest in the Zambian economy rather than carrying on paying and cutting public spending. And so that's really important also for other countries that have high debt payments. Just seeing the problems Zambia has faced, it's still been better they've gone down the path they have than if they just tried on carry on paying at the cost of cutting further and further the public services of the Zambian people.
All right, just before we go, I'd like to throw this into the mix. Does Debt Justice's proposal for legislation in the UK and New York to ensure equal debt relief from private lenders have merit? I mean, what are the potential challenges and benefits of such legislation?
Yeah, so we think that this process has shown that there is a big difficulty in getting private lenders to agree to debt relief in a timely fashion and to agree to as much as is needed. And so debtors need more power in those negotiations. And one of the things that could be done is that these debts tend to be owed under law in the UK. For Zambia and many countries in Africa, their debts are governed by a UK law. And that means the UK could bring in legislation to give debtors more ability to negotiate these debt relief deals and make private lenders take part in debt relief. Remember, these bondholders lent at interest rates of 7%, 8%, 9%, and they charged such interest rates because they said that lending was risky. Well, that risk materialized with successions of economic shocks, including the COVID crisis. And so they should not get as much money back. That's the logic of their own lending.
Okay.
But they hold out and hold out for as much profit as they can get. So we need new rules to make these private lenders be less obstructionist in these negotiations. And that could be done in the UK because there is the debts are governed here in the UK.
All right, thank you so much. I mean, that's something to take home. Thank you, Tim Jones, Head of Policy, Debt Justice, for sharing your thoughts with us today.
Thank you.
Despite possessing vital growth contributors like human capital, logistics, and institutions, South Africa's productivity growth lags behind global standards. Traditional productivity measures often overlook factors crucial for sustainable development, such as environmental impact and innovation. Analysis reveals that South Africa heavily relies on factors currently underperforming, posing significant challenges to economic and employment growth. Addressing these issues demands targeted policies focusing on education, infrastructure, institutional capacity, and innovation to foster an environment conducive to long-term, inclusive, and sustainable economic growth. And right about now, I am joined by Christy Vujoin, economist and senior manager at Strategy, PwC South Africa. Thank you for joining me today.
Good afternoon.
All right, I guess it's afternoon over there, so good afternoon to you. Now, let's begin by let us begin by demystifying the Productivity Potential Index. I mean, it's a new way of looking at productivity. First, let's look at it, and then maybe we'll also look at what differentiates it from the other, regular measures of productivity.
So there are many different measures of productivity because it's not an exact science. Many of the traditional measures look at the inputs of capital, so that would be infrastructure. They look at the human element, but we found that many of them lack some of the very important things that we think of when it comes to sustainability. So not only economic growth, but sustainable economic growth. So those would be elements like the environmental consideration. We need to understand how we grow and how we create productivity, but also not having an adverse effect on the environment. So our productivity index is one that's building upon our understanding of productivity, but making very much sure that we are also thinking about sustainability. We don't just want productivity, we need it to be sustainable over the long term.
I like what you said about sustainability and the environment. Help us, balance that particular or that aspect of this conversation. How do we, infuse this into productivity?
Well, that's part of the challenges that we have at the moment when it comes to sustainability and, for example, climate change. We know that companies need to adapt. They cannot just focus on profits. They need to focus on people. They need to focus on the environment. And it's a way of thinking. It's a way of building a strategy that sees companies go beyond just focusing on revenues and profits and dividends, but also impact on the community, impact on the environment. How do you improve the social situation within your community, within your town, for example? So that's a way of thinking about it. We've often heard the phrase ESG, environmental, social, and governance. And at a company level, that's where some of these key decisions come in. How do I make decisions that are beneficial to the environment, that also support social development, and that delivers quality governance at the same time as my shareholders actually getting their financial revenues as well?
All right, let's look at this now. South Africa's productivity is strongly determined by talk about human capital, logistics, and institutions. And these are, currently among the country's biggest economic challenges. I'd like you to talk to us about how this essentially affects the country's productivity, how that, it's driven by these forces, and yet these are the same factors that are probably responsible for the economic challenge it's going through right now. How is that affecting its productivity, and maybe how we can get South Africa out of that?
We know South Africa's got a big unemployment problem. We've got one of the highest unemployment rates in the world. So clearly, we've got a problem with productivity. If our productivity was much higher, we'd get a lot more international investment, we'd have a lot more jobs. And our challenge is getting the right things in place. As you've mentioned, our analysis shows that the key factors driving productivity, there are many of them, but the biggest three are education, it is the quality of institutions. Those are probably the two main ones that we are most concerned about, and the infrastructure is the other one. In South Africa at the moment, we've got challenges with education, long-standing challenges where we spend relatively a lot of money on education if you look at the size of the economy, but the outcomes are not great. The skill of the people leaving school, it's not as desirable. If we think of infrastructure, especially in some of our big cities, we've got infrastructure failures that are resulting in some of the roads not being usable, days on end where people don't have water, and we all know this electricity situation as well. So those are some of the big features that we are dependent on for productivity, but also at the same time, as a country, we are not doing very well at that at the moment. And we can see that in our economic growth rate, which is very low at this stage, forecasted less than 1% this year. So it's quite understandable why we are struggling, because those fundamental things that are driving our productivity and our competitiveness against other countries are really not doing as expected at this point.
Well, you've talked about unemployment, talked about education. Now, I'd like us to look at this particular one, which is infrastructure and physical capital. We know these have been a source of concern to the country. So how do you rate the government's handling of this? And what are your recommendations for ensuring that this aspect really works for the country?
Well, I think we all can understand why infrastructure is important. It's the roads that we drive on, it's the electricity the lights we put on. It's all of those elements that make businesses more efficient, more profitable. They can create more jobs. So infrastructure is fundamental to most government spending goals. If we look across the world, most governments will have a big focus on infrastructure spending. And in South Africa, as with many other countries, in the sort of the aftermath of COVID-19, there's a lot of fiscal challenges to deal with. And one of them is, how do you spend your money? And oftentimes, infrastructure is where money is taken away in order to ensure that we can continue delivering services like education, healthcare, and so on. For us, the solution to South Africa's infrastructure challenges, there are quite a few things we need to look at, but one of them is public-private cooperation. We don't have a long list of public-private initiatives in this country, but organized business and the government are working together to help solve our biggest challenges around transport, energy, water, etc. And what we are proposing is a collaboration model, very similar to many other public-private partnership initiatives, where government and the public sector enter on an equal footing, and there's governance structures that ensure that the money is spent well, that the results are actually achieved. That's the only way that we're going to sort of fix this situation. We work private sector, government sector, and other elements working together to get to our infrastructure goals and other public service delivery goals as well.
All right, let's end this with this. Your report identified corruption as a major factor, in this reality. What has, or what do you think the South African government can actually do to reverse this trend?
I think in countries across the world, we're looking at all kinds of technologies and systems that have become available in recent years, digital systems, electronic systems that help increase transparency and efficiency in financial management, in transactions, in procurement, etc. These sort of e-government systems, as they are known, they increase transparency, and that reduces the risk for corruption. But at the same time, we must think about the human element as well. It is about a culture of transparency. It's about a culture of compliance. So alongside physical systems, hardware and software, you need that human element as well. Everything combined is what you need to reduce the opportunity for corruption and, in effect, then the ability to control it.
All right, thank you so much, Christy Vijan, Economist and Senior Manager, Strategy, PwC South Africa. Thank you for coming on the show today.
Thank you.
And that's it on this edition of Business Edge. You can follow us on social media. We are at News Central TV. You can also head on to our website, www.newscentral.africa. You can download our mobile app on Play Store and App Store. Thank you for watching today. I am Perpetual Fasanmi-Peter. Bye for now.